Disadvantage of FIFO matches current revenues with older cores. Advantage of LIFO lower gross profit in periods of rising prices leads to lower taxable income. Disadvantages of LIFO management can manipulate net income with an earn a period purchase not immediately orders course of goods sold. Rarely matches physical flow of inventory. Measurement of inventory subsequent to initial recognition. The subsequent measurement of inventory depends on the course method used. Inventory accounted for using LIFO or the retail inventory method is measured at the lower of course market. Inventory accounted for using any other course method, FIFO or average course, is measured at the lower of course or net realizable value. Loss on write-down of inventory. A write-down of inventory below its course may result from damage, deterioration, obsolescence, changes in price levels, changes in demand. The loss on write-down of inventory to market or net realizable value generally is presented as a component of cost of goods sold. However, if the amount of loss is material, it should be presented as a separate line item in the current period income statement. A reversal of a write-down of inventory recognized in the annual financial statements is prohibited in subsequent periods. Once inventory is written down below cost, the reduced amount is a new cost basis. Depending on the nature of the inventory, the rules for write-down below cost may be applied either directly to each item or to the total of the inventory, or in some cases, the total of each major category. The method should be the one that most clearly reflects periodic income. Measurement of inventory at the lower of cost or market, LCM. Inventory accounted for using the LIFO or retail inventory method must be written down to market if its utility is no longer as great as its cost. The excess of course over market is recognized as a loss on write-down in the income statement. Market is the current course to replace inventory, subject to certain limitations. Market should not exceed a ceiling equal to NRV or be less than a floor equal to NRV reduced by an allowance for approximately normal profit margin. NRV is the estimated selling price in the ordinary course of business minus reasonably predictable course of completion, disposal, and transportation. Current replacement course, CRC, is not to be greater than NRV or less than NRV minus the normal profit. The excess of course over market is recognized as a loss on write-down in the income statement. Inventories are measured at the lower of course or net realizable value, NRV, regardless of the cost method used. NRV is the estimated selling price less the estimated cost of completion and disposal. NRV is assessed each period. Accordingly, a write-down may be reversed, but not above original cost. The write-down and reversal are recognized in profit or loss. Measurement of inventory at the lower of course or NRV. Inventory measured using any method other than LIFO or retail, FIFO or average course must be measured at the lower of course or net realizable value. NRV is the estimated selling price in the ordinary course of business minus reasonably predictable course of completion, disposal, and transportation. The excess of course over NRV is recognized as a loss on write-down in the income statement. Inventory measurement at interim dates. A write-down of inventory below cost to market for LIFO and retail and to NRV for all other methods may be deferred in the interim financial statements if no loss is reasonably anticipated for the year. But inventory losses from a non-temporary decline below course must be recognized at the interim date. If the loss is recovered in another quarter, it is recognized as a gain and treated as a change in estimate. The amount recovered is limited to the losses previously recognized.